Two people walk into the same bank. They apply for the same home loan amount in the same city for similar houses. Yet one gets an interest rate of 8.2%, while the other is offered 8.8%. This difference is not luck. It is not favoritism. It is the result of how banks calculate risk. Most people believe home loan interest rates are fixed numbers, but in reality, interest rate is not a decision. It is a calculation. Banks don't ask, what rate should we give this person? They ask, how risky is this borrower for us? The higher the risk, the higher the interest you pay. Every home loan starts from one base number, the repo rate. This is the rate at which banks borrow money from the central bank. Think of repo rate as the base cost of money for banks. When the repo rate increases, loans become expensive. When it decreases, loans can become cheaper. But repo rate is only the starting point, not your final interest rate. Your actual loan rate is built on top of the repo rate. Banks add multiple layers above it to protect themselves from risk. So even if the repo rate is the same for everyone, the final interest rate can still be very different. One of the most important factors is your credit score. Your credit score is a trust score. A score above 750 tells the bank that you repay on time. Below 700, the bank sees uncertainty. Lower trust does not mean rejection. It simply means higher interest. Even a small difference in credit score can change your interest rate. Banks usually place borrowers into two broad categories: low-risk borrowers and high-risk borrowers. A credit score above 750 is considered low risk. Below 700 is seen as high risk. Low risk is rewarded with lower interest. Higher risk is charged more. Now let's see why this matters. On a 50 lakh rupee loan for 20 years, a difference of just 0.6% in interest rate can cost you 7 to 9 lakh rupees extra in interest. Same loan, same bank, different risk profile. Banks also look at how much money you are putting in yourself. This is called loan-to-value ratio. If you pay a higher down payment, the bank's risk reduces. When borrowers invest more of their own money, banks feel safer lending to them. Lower risk often means better interest rates. A low down payment means the bank carries more risk. A high down payment means the borrower shares that risk. That is why higher down payments are often rewarded with lower interest rates. Banks also look at where your income comes from. Government jobs and large corporate jobs are seen as stable and predictable. Freelancers, startups, and variable income jobs are not bad, but they are uncertain. More uncertainty means more risk for the bank. When income is stable, banks feel confident about long-term repayments. When income is variable, banks add a safety margin in the interest rate. This is why two people earning the same salary can still receive different loan offers. Time itself is a risk factor. Younger borrowers give banks more working years. Longer loan tenures increase uncertainty. More years mean more unknowns. Career changes, health, economic shifts. Banks quietly price this uncertainty into the loan. Shorter tenures usually carry lower risk. Longer tenures increase exposure for banks. That extra time is another reason interest rates can vary between borrowers. After evaluating all visible factors, banks add one more layer: the risk premium. This is a silent adjustment. It is not shown clearly on offer letters. It protects banks from uncertainty across jobs, cities, properties, and economic conditions. Risk premium is influenced by many things: your location, job type, property category, age, credit history, and even market conditions. You may never see these written openly, but they all affect your final interest rate. Let's put everything together. Two borrowers take a 50 lakh loan for 20 years. One gets 8.2%, The other gets 8.8%. The difference is not accidental. It reflects differences in credit score, stability, and risk. The good news is this system is not out of your control. You can improve your credit score. You can increase your down payment. You can compare multiple banks. And yes, you can negotiate. Interest rate is calculated, and calculations can be optimized. Key takeaways. Home loan interest is not fixed. Risk decides the cost of borrowing. Small percentage differences matter a lot, and informed borrowers always pay less. Money is not complicated when you understand how it works. This channel exists to explain money simply, so you can make better decisions, not expensive mistakes. Subscribe if you want clarity, not noise.